Huddle up, team, and thank you so much for joining us today. If you bought a home 3 or more years ago, you are probably rich in equity.
That's right.
That is the topic of our show today. We're going to talk all about that, how to access it, and what to do with it.
That's right. Thanks, honey. So the money in your home, that equity, man, I learned this from Garrett Gunnarsson. It is in equity jail, right? It is tied up. You cannot access that easily. And we are going to talk about how you can make a change so that you can put that money to work to help you achieve your financial goals. But first, we are John and Tara Thorman. We are financial coaches, and we are here to serve you, married couples that have got money issues, communication issues, right? And we're here to help fix your money problems and your communication problems so that you can win your money game and live your best life. All right? All right. Let's dig right into this. So maybe it's time for an equity jailbreak, right? We got to bust that money out of prison and put it to work for you and your family so that you can accumulate wealth faster, have greater peace of mind, reduce financial risk, right? And one of the financial risks we're concerned about is cash flow interruption, right? If you've got all of your money tied up, it's not accessible, it's not liquid, and that could pose a problem, and we want to fix that with you. Now, depending on your age, what you do and how you do it is really important, okay? What we recommend or would suggest for a young person is completely different than what we would suggest for an old person. So let's take a quick look at the money game plan, and you can see here in the early years from 25 to 55, that's what we're calling the asset accumulation phase. This is the common money game plan being used by most people currently. And in this asset accumulation phase, we are focused on growing wealth, accumulating assets and growing assets. Once you hit 55, the phase changes and we get into asset protection. And that's when we're going to start looking at, okay, how can we pay off this debt so that you don't have a monthly mortgage payment when you're in retirement. But right now, we're looking at this early phase, right? From 25 to 50, maybe 55 at the most. In that accumulation phase, we want to know what can we do to maximize the equity in our home to help us achieve our financial goals. And that's what we're going to look at today, okay? Now, there's 4 main ways that you can access the equity in your home, all right? The first one is a cash out refinance. Maybe you've heard of that one before. Cash out refinance. You got to go through the whole process again, like you did when you got your mortgage, right? And one of the problems are expenses, right? It's expensive. You got all kinds of fees. It could be 2 to 6% of the value of the home when you get it appraised now, which like legitimately could be double what you bought it for 5 or 6 years ago. So like you're loaded with equity, right? We are not recommending that for most people. And the main reason is because if you bought your home 3, 4, 5, 6 years ago, man, you got a really good interest rate. And interest rates have doubled or more than doubled in the last year. So not a good option. So let's look at number 2 option is a HELOC. That stands for Home Equity Line of Credit. Right? And this is super popular right now. It is blowing up. The search volume is up like, I don't know, 305% or something this year. It is crazy. Everybody's looking for HELOCs, and we're going to get into why here in a minute. But the third way to access the equity in your home is a home equity loan. That's different, very different from a line of credit. This is a loan, and we'll go over some of those differences here in a minute. Now, the last way is for our people nearing or in retirement. And there's some qualifications here, like you need to be generally 62. Sometimes you can get it at age 55. But the other way to access the equity in your home is what's called a reverse mortgage. Now, we're not going to be talking about refinancing today. We're not talking about reverse mortgages today. We're going to concentrate on HELOC,
and home equity loan.
And the loan. That's right. Very good. Okay. Now, if we look at the most popular uses of your equity in the home, right? The number 1 most popular recommendation is
remodel.
Home improvements. Like getting a new kitchen.
Yep.
The ladies like that, right?
Yes. Or bathroom.
or bathroom. What can you do to improve the value of your home, update it so that you can enjoy it more, but also help increase the market value? Now, maybe you need a new roof. You need to be doing these kind of, maintenance things periodically at certain times at different ages of the home. And this is a great use of the equity in your home to maintain its value and help improve it a little bit. Okay. Very common. The next way or next thing to use home equity for is
Special events.
And if you've got girls, you know that weddings are going to be an issue, right? You're going to have to pay for that. So special events or a special vacation, maybe like a big anniversary, like our 30th is coming. 2 years, we'll be 30 years married. And so we'll have to do something special. So that could be a good use of some home equity. The third one is getting a home equity loan or a line of credit could actually help improve your credit score. Because you've got another alternative source of debt that you can manage. Next, we use the home equity in our home for emergency fund, which we like to call peace of mind. And you cannot put a price on peace of mind, right? It's so important. And you buy peace of mind a little bit at a time, putting that money away. Or you can get a jump start on it by pulling out some home equity. Then, number 5, you can use some of your home equity to take time off. Maybe go on a sabbatical, take care of a loved one who's maybe, not doing well, or like Tara and I have done the last few years, we've really just taken time to be at home and be with each other and work on our relationship. And that's been super important and just super special. And the results have been amazing. And we're really thankful for that opportunity to do that. So maybe that's something that you might want to do too. But most financial gurus advise taking the equity out of your home primarily for home improvement projects, right? Because the debt's related to the value of your home, and you're improving the value of your home and all that kind of stuff. So that's good. But the elephant in the room right now at this point is debt consolidation. Right. I mean, let's face it, a lot of people are using the equity in their home to pay off their debt, and especially their high interest rate debt. And the financial gurus don't like that. Right?
Not a good idea.
They advise against it, right? And I think that's kind of crazy, frankly. I mean, because if you do the math, it makes sense to take the equity at a low interest rate and pay off high interest rate and consolidate it, lower your payments, all that kind of good stuff, right? You'll save yourself a lot of money in interest, but they don't like it. And I'm okay with that. We need to talk about it. And I guess that's really the issue, right? Is what got you into the debt situation that you're in
to begin with,
right? So we need to address the the emotional side of it, right? Because the rational side is the math and the numbers. And we go, oh yeah, it makes a lot of sense. We should do this. But that's not what drives your behavior. What drives your behavior is the emotional side of your brain and the psychology of money. And we got to have some conversations about that to really identify, why are you in this position? Because if there's an issue, if there's a problem, right? We got to fix that before we start tapping the equity in your home. Because if it doesn't get fixed, then all that happens is you've got access to more money and you'll spend it and then crank up your credit cards again. Right? And that's a terrible situation that we don't want you to be in. And that's why most gurus just tell you don't do it. Well, we're not going to do that because we are assuming that you're an adult and are responsible or capable of being more responsible, right? And we can work on this and fix it so that that doesn't happen again. All right. Anything else about that issue? We got the rational side is the math, and it will make sense. And then we got the emotional side, which drives the behavior. And we got to address that because we don't want to put you back into a situation where you're incurring more debt. Right? Okay. One real quick warning. I'm seeing a lot of people promoting the use of a first lien HELOC, home equity line of credit, and following a strategy called velocity banking or accelerated banking or some other kind of marketing term applied to this concept. And I want to say, warning, right? That doesn't always work. It depends on your unique situation and how you apply it. And it's not going to be some, panacea to fix all your problems. Like I said, we got to get back to what's causing the issue first before we try to come up with a solution for it. Okay. So just be cautious about that. If you're exploring that or interested in that, we can coach you through that process to find out how to best address your cash flow management situation so that your dollars are working as hard for you as possible and can get you out of debt. But, they're promoting get out of debt, including your mortgage, in 5 to 7 years. Well, frankly, you should not get out of your mortgage in 5 to 7 years because that is your lowest cost of money, right? If we're doing this rationally, if I got a 3% mortgage and I can make, 6% interest safely, why on earth would you pay that mortgage off? Like, that doesn't make any sense. You can pay it off in 20 or 30 years after you've accumulated a bunch of money and then write a check for it. But don't put all that money to paying off a low interest loan when you can go make more money safely somewhere else. But we're happy to have that conversation with you and walk through that. But that's what we're here for as coaches, is to help you make those kind of decisions, right? Okay. Next, baby, what do we got?
Uses of home equity to build wealth.
Okay, this is the fun part, right? So we talked about the primary uses of home equity loans, what people are talking about. Well, let's look at how we can multiply your efforts and help you accelerate your wealth accumulation so that you can get to financial independence and financial freedom faster. That's using the equity in an investment situation, right?
Yes.
So again, this has got risks, right? I mean, but everything has risks. I mean, there's a risk of not doing anything, right? So we got to make wise decisions and calculate the cost of the risk and see if it's the right thing for you. But we got a few uses of equity to build wealth. Number one is invest in yourself, right? The best investment you can make is the ones you make in yourself to improve your mindset, your skill set, and your tool set. Because those things, if you multiply those together, that are going to equal your ability to acquire assets, and assets will produce more income that will more than cover the cost of the loan, and you're making positive gains all along the way, okay? The next opportunity fund, that's a good reason to get equity out of your home, break free out of equity jail, use that money to have an opportunity fund. Maybe if you're into real estate, you can use that money to use for a down payment to buy your next property. Or if you're a business owner or entrepreneurial, you can use some of that money to reinvest in your existing business to grow faster, or to start some other kind of business, which is risky, but that's what it's there for, right? Or the third option that I like a whole lot and that most people don't know about or aren't talking about, I call the tax-exempt wealth building account. Right? Tuba. Yeah, how do you like the sound of that one? The tax-exempt wealth building account, okay, this is used by wealthy people for like decades and decades and decades. It's a way to stash your cash, okay, your surplus cash, stash it, and earn a great rate of interest, but it's tax-free, okay? And you can use it then in the future as collateral on a low interest rate loan to go do something else with. So now your money's doing two things at the same time. It's still earning over here in your account, but you're got low interest rate money to go invest on another project. Super awesome. And we're happy to go over those details with you, but that's another way. Again, use the equity because it's dead equity right now. It's just sitting there, not doing anything, right? And you can put it to work to accelerate your trajectory and get to wealth, financial freedom a lot faster. The potential negative is that you are using your home as security for the debt, which means if you don't make the payment, they could foreclose. You could lose your home.
For sure.
So, I mean, this is not something to, take lightly, right? This is a significant, issue. One of the pros actually that I like too of the HELOC is that it's fast. You can get approved quick and you can get your money quick. And there can be no cost. Like there could actually be no upfront expenses to get it. Maybe you'll have a small one, a couple $100 or something like that, but it's very inexpensive and it's fast. to get a HELOC.
Not difficult, right?
With the home loan, it's not like that, right? It's going to take a little bit longer, and there's going to be some more costs in order to access the equity.
And you can use the money though in either one for anything,
Right?
which I in part I think that's very important that especially with the HELOC, because you end up do the shock payment. Talk a little bit about that.
And so there's a term, shock payment, right, with the HELOC, because you can set it up where you just make the minimum monthly payment is the interest every month, right? You're not putting anything on the principal,
which could maybe be only like 150 or 175. I mean, it's not.
It just depends, right, on how much you borrowed, what the balance is, and your rate. But if you're used to just making interest-only payments all the time, and you get through the drawdown period, the 10 years, and then you go into the repayment period for 20 years, well, now your payment could double, possibly, right? That's the shock. Right. So you got to be aware that the flexibility you have with just making interest payments early is not going to be forever unless you refinance the whole thing and get a new HELOC in 10 years. Right. Which could be a possibility if you want to drag it out longer. Right. Right? Right. That is a possibility. Yeah. One thing to be aware of with the HELOC, and we saw this back in 2008, okay? The home equity line of credit is open and more flexible, right, than the loan. But that means that two things could be done, right? The bank, if they're in a situation and the housing prices collapse and they don't want you to have more debt on your home than what the home is worth, right? So if you've got a really big line of credit, like $100,000 or $200,000 because you got so much equity in your home, and they'll cut it. Like they can cut it back down to whatever makes them happy again. But you think you've got all this credit line to be able to go and use. And your remodel is halfway done. Oh my gosh. Right? That would be really bad. And you don't have a kitchen sink yet or something. Oh, or appliances or flooring. And it happens. Yeah. So you got to be careful about the timing and understand what's happening with the economy and all this kind of good stuff. But they could cut the limit. So from, 200 to 25. I mean, it could be drastic. But they could also do something called freezing it, where they'll freeze the credit line. So that means that whatever you've got out right now, they'll freeze it and you can't go above that. Or if you paid it down, you can't go back to where you were. Like all you're going to be able to do once they freeze your account is make your minimum monthly payment. Right. There is no thaw. No, jacks up everything. Okay. So you got to be really careful. But that's something to consider as we head into some uncertain waters here, economically speaking. Right. Is if you've got a lot of equity, I would encourage you to maybe go and get a line of credit, especially if it doesn't cost you anything, and have it available in the background, because it costs you nothing if you don't use it. Right. Right. It only costs you if you pulled money out and now you have a balance that is being charged interest every day. But if you don't ever use it, it's like your backup or your ace in the hole, waiting to help support you if you need that kind of a financial reserve. Okay. But we just got to be careful. If the housing markets crash with the HELOC, the terms, could get changed. That's a unilateral thing. The bank's just going to make that call and you don't have any options with them at that point. It doesn't mean you couldn't go somewhere else and try to get one, but that one institution you're with could be an issue. You're not going to experience that with a loan. Right. Because it's a fixed amortized schedule. Totally different. Totally different. You're not going to have that issue. Right. Okay. So how do you know which one is best for you? What are you going to do? We want to encourage you that you got to come together as a couple. You got to talk about this, but also that's what a coach can do. We can come into those conversations and walk you through that process, explore your options, and help you arrive at the right best decision for your family. So I hope you found this helpful. We would love to get some response. If you could crush that like button for us, that would be awesome. And subscribe to the channel. Drop a comment. Let us know what you thought about this. If you got some other specific questions you want us to address, we'll be happy to do that too. And I want to encourage you as well, if you haven't checked out our video earlier on how to reduce your payment, by eliminating your PMI, your private mortgage insurance. Go check that out, because you could save, thousands of dollars over the next few years by getting that thing knocked out. And you'll qualify. If you qualify for this home equity situation,
Right.
you could take care of that too. So another way to save some money.
Good job.
But that's all for now, guys. Have a great week, and be sure to let us know. Reach out to us. Well, I'll put a link below if you want to connect and get some one-on-one counseling or coaching with us so that we can address something specific for you. We're here to help. We'll see you next week. Bye-bye.